War is ending. Oil is falling. Markets are celebrating. And most investors think they already know what happens next. They believe cheaper oil automatically means weaker inflation. Weaker inflation means less pressure on the Federal Reserve. Less pressure on the Federal Reserve means lower interest rates, and lower interest rates mean higher silver prices. Simple, clean, easy. The problem is that financial markets are rarely that simple, because while everyone is focused on the collapse in oil prices after the US-Iran agreement, something much bigger is developing beneath the surface of the silver market, something that could determine where silver goes for the rest of 2026. Over the last few days, oil prices have fallen sharply as traders began pricing in the reopening of the Strait of Hormuz and the possibility that global energy supplies may normalize much faster than expected. Brent crude briefly slipped below the $80 level, while traders rushed to unwind the massive geopolitical premium that had been built into energy markets during months of uncertainty. Normally, that would be viewed as negative for precious metals. After all, gold and silver often benefit from inflation fears. If inflation fears disappear, shouldn't precious metals fall? That is what many investors assume. But that assumption ignores something critical. Silver is not just a precious metal. Silver is also an industrial metal. And in 2026, the industrial side of silver has become more important than ever before. Think about what lower oil prices actually do. They reduce transportation costs. They reduce manufacturing costs. They reduce operating expenses for factories. They improve profit margins for businesses. And when businesses become more profitable, they invest more. They build more. They expand more. They consume more raw materials, including silver. That is why silver often behaves differently than gold. Gold can survive on fear alone. Silver needs growth. Silver needs industry. Silver needs manufacturing. Silver needs technology. And despite all the volatility we have seen this year, those demand drivers remain intact. Artificial intelligence infrastructure continues expanding. Data centers continue expanding. Solar deployment continues expanding. Electrification continues expanding, and every one of those industries requires silver. Now let's talk about something that almost nobody is discussing. The silver market today is completely different from the silver market 5 years ago. 5 years ago, investors could argue that silver was mostly a monetary metal. Today, that argument is much harder to make. The world is consuming enormous amounts of silver for industrial purposes. Unlike gold, much of that silver is not easily recoverable. It gets used, consumed, embedded inside products, locked away in electronics, integrated into industrial systems, gone from circulation. That changes everything, because every ounce consumed by industry is one less ounce available for investment demand. And if investment demand suddenly accelerates at the same time, industrial demand remains strong, the market can tighten very quickly. That is exactly why so many analysts continue watching silver inventories so closely. Not because inventories are about to hit zero, but because inventories reveal whether supply is keeping up with demand. And lately, the answer has been increasingly uncomfortable. Supply growth has struggled to match long-term demand growth. Mine production cannot be increased overnight. New projects take years, permits take years, infrastructure takes years. Meanwhile, demand can change in months. That imbalance is why silver remains one of the most fascinating commodities in the world. Now add another factor, the Federal Reserve. Because whether investors like it or not, the Fed remains one of the most powerful forces influencing precious metals. And right now, the Fed faces a difficult problem. Inflation has not disappeared, economic growth has not collapsed, labor markets remain relatively resilient, yet falling energy prices are beginning to ease some of the inflation pressure that policymakers have been fighting. That creates uncertainty. And markets hate uncertainty. The upcoming policy guidance from Fed officials may end up being more important than the actual interest rate decision itself. Investors are not just looking for today's decision. They are looking for clues about tomorrow. Will policymakers remain cautious? Will they become more dovish? Will they acknowledge the impact of falling energy prices? Those questions matter because silver often moves long before official policy changes. Markets anticipate. They do not wait. And that is why the next few weeks could become extremely important, because silver is now sitting at the intersection of several major forces: lower oil prices, potentially softer inflation expectations, a shifting Federal Reserve outlook, continued industrial demand, and ongoing supply constraints. Individually, each factor matters. Together, they become powerful. But there is another reason investors should pay attention right now: sentiment. Just a few months ago, silver was one of the hottest trades in the world. Everyone wanted exposure. Every rally attracted new buyers. Every headline generated excitement. Then came the correction, and suddenly confidence disappeared. That emotional swing is important, because some of the biggest opportunities in financial markets emerge when strong long-term fundamentals collide with weak short-term sentiment. The question is simple. Has silver's long-term story changed, or has market psychology changed? Those are very different things, and the answer may determine where silver goes next. Because when you strip away the headlines, the tweets, the politics, and the daily volatility, the core silver thesis remains surprisingly straightforward. The world continues requiring more silver. Supply growth remains limited. Investment demand remains highly sensitive to changes in monetary policy. And global uncertainty has not vanished. The war may be ending. Oil may be falling, but the forces driving silver are much larger than a single geopolitical event, and that is where the real story begins. The next piece of this puzzle takes us away from oil, away from geopolitics, and straight into the heart of the silver market itself. Because while headlines are focused on peace agreements and falling energy prices, professional investors are watching something completely different. They are watching physical silver. And that distinction matters, because there are really two silver markets operating at the same time. The first is the paper market. This is where futures contracts trade. It is where hedge funds speculate. It is where traders buy and sell silver exposure without ever touching a single ounce of metal. The second is the physical market. This is where manufacturers, refiners, governments, industrial users, and long-term investors compete for actual metal. Most of the time, these two markets move together, but not always. And when they start moving apart, things can get very interesting very quickly. Think about what happened earlier this year. Silver exploded higher and briefly reached levels that few analysts expected to see so quickly. Then came a brutal correction. Prices fell. Speculators rushed for the exits. Financial media declared the rally dead. And yet something strange happened beneath the surface. Physical demand never completely disappeared. In fact, many of the industries consuming silver continued operating exactly as before. Solar manufacturers still needed silver. Electronics manufacturers still needed silver. Medical technology companies still needed silver. Data center construction still required silver. Artificial intelligence infrastructure still required silver. Nothing about those industries suddenly stopped. The correction mostly happened in sentiment, not in industrial consumption. And that is why many analysts believe the silver market today is stronger than it appears at first glance. Let's talk about artificial intelligence for a moment, because AI may become one of the most important silver stories of this decade. When most people hear the words artificial intelligence, they think about software, chatbots, algorithms, large language models. But AI is ultimately a physical infrastructure story. Every AI system runs on hardware, servers, processors, networking equipment, cooling systems, power distribution systems, massive data centers, and all of those systems require silver. Silver remains one of the most conductive materials on Earth. Its electrical conductivity is unmatched. Its thermal conductivity is unmatched. That makes it incredibly valuable for advanced technologies. Now consider what is happening globally. Technology companies are spending hundreds of billions of dollars expanding AI infrastructure. New data centers are being announced across North America, across Europe, across Asia, across the Middle East. Every major technology company is racing to build capacity. This isn't a one-year trend. This is likely a multi-decade transformation, and silver sits directly in the middle of it. Then there is the energy transition. Regardless of where someone stands politically, one reality is difficult to ignore. Solar installations continue growing around the world, and solar panels consume silver, a lot of silver. Every new solar project creates additional demand. Every expansion of renewable energy infrastructure creates additional demand. Every government incentive program creates additional demand. Now combine that with electric vehicles. Modern vehicles contain far more electronics than previous generations. Advanced sensors, power management systems, communication systems, safety systems, battery technologies. Each innovation increases the need for conductive materials, including silver. This is why many long-term investors continue focusing on demand rather than daily price fluctuations. Because demand tells you where the market may be heading years from now. Price tells you where emotions are today, and emotions change much faster than fundamentals. Now let's turn our attention to another area that deserves much more attention than it receives. China. Whenever investors discuss silver, China inevitably enters the conversation, and for good reason. China remains one of the largest consumers of industrial metals on the planet. Its manufacturing base is enormous. Its solar industry is enormous. Its electronics industry is enormous. Its electric vehicle sector is enormous. When Chinese demand accelerates, global commodity markets notice. When Chinese demand slows, global commodity markets notice. That influence cannot be ignored. Recently, analysts have been paying close attention to Chinese silver flows, inventory trends, and industrial activity because they offer clues about future demand. The reason is simple. China often sees shifts in industrial consumption before the rest of the world notices them. And when those shifts become visible globally, prices have often already moved. This is one reason sophisticated investors monitor physical markets so closely. The headlines may focus on central banks and interest rates, but real-world consumption often tells the story first. Now let's discuss one of the most misunderstood concepts in the entire silver market: supply deficits. Many people hear the term supply deficit and assume it means silver is about to disappear. That is not what it means. A supply deficit simply means total demand exceeds newly mined supply plus recycled supply during a specific period. The market can still function, inventories can still exist, trading can still occur, but persistent deficits matter because they slowly draw down available inventories over time. Imagine a reservoir. If more water leaves than enters year after year, eventually, the water level falls. Not immediately, not dramatically overnight, but steadily. That is the concern many analysts have regarding silver. Not a sudden shortage, a gradual tightening, a gradual reduction in flexibility, a gradual increase in sensitivity to demand shocks. And when markets become less flexible, volatility often increases. That brings us to one of the most important questions investors should ask right now. What could go wrong with the bullish silver thesis? Because every investment story has risks. And understanding risks is what separates serious investors from gamblers. The biggest bearish argument is actually straightforward. Economic growth could slow significantly. If global manufacturing weakens, if industrial activity contracts, if corporate investment slows, industrial silver demand could weaken. That would reduce one of the strongest pillars supporting the market. Another risk involves monetary policy. If inflation unexpectedly reaccelerates despite falling oil prices, central banks could remain more restrictive than investors currently expect. Higher rates generally strengthen the dollar. A stronger dollar can create headwinds for precious metals. There is also the possibility that investors have become too optimistic too quickly. Markets rarely move in straight lines. Even powerful bull markets experience painful corrections. We have already seen that this year, and it could happen again. But now consider the bullish side. What happens if industrial demand remains strong? What happens if AI infrastructure spending accelerates? What happens if renewable energy investment continues growing? What happens if inflation cools enough for monetary policy expectations to soften? What happens if investor demand returns at the same time physical demand remains elevated? That combination could become extremely powerful, because silver's history shows something interesting. When silver moves, it often moves much faster than most investors expect. Gold tends to behave like a heavyweight boxer, steady, measured, deliberate. Silver behaves more like a sprinter, volatile, explosive, unpredictable. That characteristic is why silver attracts so much attention during precious metals bull markets. Its gains can be extraordinary, but its corrections can be equally dramatic, which is why understanding the bigger picture matters. And right now, the bigger picture is becoming increasingly difficult to ignore. The war may be ending, oil may be falling, inflation expectations may be shifting. The Federal Reserve may be approaching an important turning point. Industrial demand remains significant. Physical silver remains strategically important. And investor sentiment remains far more cautious than it was at the beginning of the year. Those ingredients create a fascinating setup. The question is whether they will be enough to launch the next major move, because in the coming weeks, attention will shift away from oil headlines and back toward something far more important: the actual balance between supply, demand, and investor confidence. And that balance may ultimately decide whether silver simply stabilizes or begins another powerful advance that catches much of the market completely off guard. And this is where everything comes together. Because after all the headlines, all the volatility, all the predictions, and all the noise, the silver market is approaching a moment that could define the second half of 2026. Not because of one event, not because of one politician, not because of one Federal Reserve meeting, but because multiple forces are beginning to align at the same time. The war premium that supported oil prices for months is disappearing. Energy markets are repricing. Inflation expectations are shifting. Investors are reevaluating interest rate forecasts. Industrial demand remains remarkably resilient, and physical silver continues to occupy a unique position that very few assets can replicate. That combination deserves attention, because the biggest moves in financial markets rarely happen when everyone is watching. They happen when most people are looking somewhere else. Right now, most investors are focused on stocks. Some are focused on artificial intelligence companies. Others are focused on cryptocurrencies. Many are focused on central bank policy. Very few are paying attention to the bigger picture unfolding in silver. And history shows that when an asset moves from being ignored to being desired, the transition can happen much faster than anyone expects. Think back to earlier this year. Silver shocked almost everyone. The move higher was so aggressive that even many silver bulls were surprised by the speed. Then came the correction. Fear returned. Confidence disappeared. The headlines changed. And suddenly the narrative became completely different. That is how markets work. At the top, people believe prices can only rise. At the bottom, people believe prices can only fall. Reality usually lives somewhere in between. And that is why the next few months may be more important than the last few months, because the market is now being forced to answer a very important question. Was the correction the beginning of a larger collapse? Or was it simply a reset inside a much larger bull market? That question matters because the answer determines everything. Let's imagine the bearish scenario first. Suppose economic growth weakens significantly. Suppose manufacturing activity slows. Suppose industrial demand softens. Suppose central banks remain more aggressive than markets currently expect. Under that scenario, silver could remain trapped. Prices could struggle. Momentum could fade. Investors could become increasingly frustrated. That is a possibility. Every serious investor should acknowledge it. Markets do not owe anyone a rally. They do not move according to hope. They move according to reality. But now consider the opposite scenario. What if inflation continues cooling? What if lower energy prices ease pressure throughout the global economy? What if businesses increase investment? What if AI infrastructure spending continues accelerating? What if solar demand remains strong? What if industrial consumption remains higher than expected? What if investor demand begins returning at the same time? Suddenly the equation changes. Because silver does not need perfect conditions to move higher. It simply needs conditions that are better than the market currently expects. That distinction is critical. Markets move based on expectations, not absolute reality. If investors expect weakness and conditions improve, prices can rise. If investors expect strength and conditions disappoint, prices can fall. Today, expectations remain surprisingly cautious. Many investors are still emotionally anchored to the recent correction. Many remain focused on the volatility. Many remain hesitant after experiencing one of the sharpest pullbacks of this bull cycle. That hesitation is understandable, but it is also exactly what makes this period so interesting. Because major bull markets often climb a wall of worry. They advance while people remain skeptical. They advance while doubts remain high. They advance while investors continue looking for reasons not to participate. Only near the end do they become universally loved, and silver is nowhere near that stage today. In fact, many investors remain deeply divided. Some believe silver is preparing for another explosive move. Others believe the rally is over. Whenever a market creates that level of disagreement, it usually means uncertainty remains high. And uncertainty creates opportunity. Now let's talk about the number everyone wants to know. Where could silver go by the end of 2026? No one knows for certain. Anyone claiming certainty is selling confidence, not analysis. But we can discuss reasonable scenarios. In a conservative scenario where economic growth remains stable and monetary policy gradually becomes less restrictive, silver could revisit previous resistance zones and challenge levels that seemed impossible during the recent correction. In a stronger scenario where industrial demand exceeds expectations, inflation continues cooling, and investment demand returns aggressively, silver could surprise almost everyone once again. Because remember something important. The move from the low 30s to above $100 happened far faster than most analysts predicted. Markets have already proven they are capable of dramatic repricing when conditions align. That does not guarantee it happens again. But it reminds us that silver is not an ordinary asset. It never has been. It sits at the intersection of technology, manufacturing, energy, monetary policy, investment demand, and global economics. Few commodities have that combination. And fewer still have a market small enough that changes in demand can have an outsized impact on price. That is why investors continue watching it so closely. Now, I want to leave you with one final thought. Imagine two investors looking at the exact same chart. The first investor sees volatility. The second investor sees opportunity. The first investor sees risk. The second investor sees potential. The first investor focuses on what happened over the last 3 weeks. The second investor focuses on what could happen over the next 3 years. Neither is necessarily wrong, but their time horizons are completely different, and time horizon often determines outcome. The people who become exhausted by silver are usually those who expect every week to be extraordinary. The people who remain patient are usually those who understand that structural trends take time. Mine supply does not change overnight. Industrial demand does not change overnight. Infrastructure build-outs do not change overnight. Technology revolutions do not change overnight. But over time, those forces can reshape entire markets. That is why the silver story remains one of the most compelling stories in commodities today. Not because prices only go up, not because risks do not exist, not because every prediction will come true, but because the underlying drivers continue evolving in ways that deserve attention. The war may be ending. Oil may be falling. The headlines may move on to something else next week. But the forces influencing silver will still be here. Industrial demand will still matter. Monetary policy will still matter. Physical supply will still matter. Investor psychology will still matter. And as those forces collide throughout the remainder of 2026, the market will eventually deliver its answer. The only question is whether that answer arrives gradually or all at once. Because if history has taught silver investors anything, it is this. Silver spends long periods doing almost nothing. Then it spends very short periods doing what nobody thought was possible. And the next chapter of that story may be much closer than most people realize. If you followed the silver market through the rallies, the corrections, the fear, and the excitement, then you already know something most investors never learn. The biggest opportunities rarely feel comfortable when they begin. Stay focused on the facts, ignore the noise, and watch what the market does, not what the headlines tell you to think. The next few weeks could reveal a lot about where silver is truly headed, and if the signals start aligning, the move that follows could be one that investors talk about for years. Until next time, this is AG John Silver Update. Stay informed, stay prepared, and I'll see you in the next video.